From the morning reading, October's biggest winners. Within the large cap S&P 500, breadth was the strongest as 83.2% of stocks in the index were in the black for the month. October was less positive for the small cap stocks, where less than 3/4 of the stocks in the index, 73.4%, were positive, which is nearly 10 percentage points lower than the reading of the large cap S&P 500. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:45 a.m. Central Time, and I am recording this in preparation for the market day of November the 3rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's take a look at some charts here real quick. There was some really interesting things kind of developing here. First of all, we had the big range. We've been talking about that for months. And then we had the breakdown, of course. We'll understand that this breakdown was like a 4 or 5 standard deviation move. And, that was a huge breakdown, very violent, very fast. And yet, obviously, we bounced, consolidated, revisited the bottom. And then I want to focus on this area here, where we go from this revisit area back to where we finished at the close yesterday. This difference here, and we'll call it 1870 to 2104 kind of area. So 1970, 2070, that's 200 and we'll call it 35 points, 235 points. Basically 235 points straight up with hardly a pause. We had the one pullback here for a day, 2 day, 2 day, 2 day, 2 day, and then on you go. And each of these small pullbacks, these 2-day pullbacks, were very small. So to go this kind of move this fast is extremely exceptional. And yesterday's action was really, frankly, a little surprising, both in when it happened and as well as how far it went. Normally, Monday high breakouts are really low probabilities. Now, we did have the seasonality impact yesterday. It's the first trading day of the month, and that's when you get 401k money coming in to the market, and that mutual fund money must be invested. Those managers are not allowed to sit in it in cash. They don't market time that money. When that money comes in from the various corporations and other individuals, it must be invested. Now, obviously, they have great discretion as to where to invest it, what companies and the like, but they must invest that money. And so normally the first day of the month, and then either the 15th or 16th, will also be a bias to bullish. But this was pretty amazing action here. And understand, when we take a look at the standard deviation moves, I've got some stats for you I'm going to share when we get into the volatility report. But just keep this picture in your mind. Very unusual action. The other thing about this is, as I mentioned from the morning reading, where is this breadth coming from? And you see the S&P here, and you see the Dow, which has also got a very similar kind of profile. But then we look at the Russell, and the morning reading mentioned how the Russell was like 10 percentage points less just in terms of being positive. Forget about how positive it was. And it's way behind the other two large cap, big cap, kind of usually slow, steady, dividend earning kind of companies. We don't normally look at McDonald's or Pepsi to be, the big leaders in growth. We look at, companies that many of us have hardly ever heard of to be those high percentage leaders. Well, with the Russell, you've had a noticeably different profile in the summation, but what you've not had is not just wide participation, but heavy participation. Now, we saw with the NASDAQ, especially this last week where we had a couple big components have successful earnings, where we've driven all the way up to a 52-week high. And indeed, this is the first of the 4 indices to put in a new all-time high. And this actually, on an absolute basis, goes back, some 15 years to get to this all-time high in the NASDAQ. Now, in inflation-adjusted terms, you still got a ways to go. But still, first thing first, and you got to say, hey, the NASDAQ is clearly the first here and is the one that is leading the way. But again, that breadth, I keep getting worried about this breadth. And let's take a look at a couple special ETFs. This is the IBD Top 50. And typically what you have in the IBD, Investors Business Daily, this is an ETF that mirrors that top 50 and ranks those holdings with number 1 having a heavier weight than, say, number 50 in that list. Well, this is generally made up of aggressive growth, often small cap oriented companies. And so this is supposed to be the best of the best in terms of growth. We've just had a move that in the S&P went some 235 points in about a 5-week period. That's the biggest move in that period of time in 4 years. And yet here is the best of the best growth-oriented companies, and they can hardly get off the dime. I find that quite interesting. In fact, it's still in the cloud. The close yesterday was still in the cloud. It's not even broken out of this consolidation pattern into a bullish breakout yet. And yet the S&P in relative terms, the NASDAQ would be up here. The S&P would be up here, and here are these growth-oriented best of the best, and they're still wallowing way, way, way behind. Another way to look at this is this ETF. This is your dividend aristocrats. So these usually are your long, slow, steady earners. Get that 2% dividend each year, and just kind of and supposed to be less volatile, but also not going to be getting you anywhere quick. Well, look at where this is. I mean, it's back near its all-time highs, much like the S&P. And then contrast that to the one that we just looked at, the FFTY. So what has been driving this big rally? Well, guess what? It's been those long, slow, steady Eddie, dividend-oriented, or big cap companies, whether it's comprised of the NASDAQ 100 or the the Amazons and Googles, or it's comprised of the Dow 30 or those biggest of the big and the S&P 500 and perhaps even the 100. Those are the kinds of companies that have been leading us up off the bottom. So this whole rally has been built on a relatively defensive posture, where people have, not just at the beginning of the rally where you would expect them to go into the most defensive names, but throughout this rally, much of this has been on the back. Now, not all of it. Obviously, I'm overstating to be able to say that, but I want you to just get a sense that much of this gain has been done in kind of boring dividend large cap companies, as opposed to where we might expect healthy bulls to be occupying. So enough on the graphs there. Well, we'll take one quick look at the VIX futures. As you'd expect, we're dropping here, not quite as low as you might want to go. If we start getting down around a 13.5 and stuff like that, that's where you might want to think about reversion to the mean and doing volatility plays and stuff like that. We're not that low yet, but we're starting to kind of tickle the area and start to get that on the watch list. So kind of keep that in mind. So let's quickly go to our morning report. Where are we after the big move yesterday? Relative weakness, but nothing pronounced. We're down like 0.25% in all four of the U.S. broad market indices. Crude oil's up about 0.75%. Euro's down about 1/3%. Bonds are scratch, which is kind of interesting. Anytime you see bonds, not doing the inverse in a similar proportion as the market, that tells you there's not probably going to be a big move at hand yet. Gold is down about 1/3%. Overseas action kind of mixed. China down only 0.25%. Hong Kong up almost 1%. Japan down over 2%. Germany down about 0.25%. United Kingdom at scratch. In terms of the macroeconomic reports for today in the United States, this is relatively light, and factory orders is really the only thing of note. For tomorrow, you have FOMC member Brainard speaking, ADP non-farm. That's kind of your precursor to the monthly employment report. You have Fed Chair Yellen speaking, and then ISM non-manufacturing PMI, and of course the regular Wednesday crude oil inventories, and then finally FOMC member Dudley speaking. Also member Fisher speaking. Now, of course, a big one later in this week will be the monthly employment report, and that one will be out on Friday. In terms of volatility, and I did want to speak to this just a little bit larger today. You see the short-term VIX down below 14 now, 13.68. Skew continues to be elevated. That is one of our warning signs. But IV percentiles very, very low. 8 on the S&P, 18 on the Russell, 12 on the NASDAQ, and 15 on the Dow. Notice here, we did have standard deviation moves put in on all 4 broad market indices. 1 standard deviation move on 3 of the 4, but on the Russell, a 2 standard deviation move. And I wanted to focus on this right here. Now, we talked about how that move back in August was like a 4 or 5 standard deviation move over several days, about 3 or 4 trading days to kind of get you down to that bottom. Much of this action here, though, where we've had these multi-standard deviation moves, has been to the upside. Now, the Russell's not caught up, but it certainly has been playing catch up of late and has been quite a bit stronger in relative terms. And you see, in most of these cases where the S&P was up 1, the Russell was up 2 standard deviations, and here 1, 3 standard deviations, these kinds of things. But also focus on this cluster. And now often volatility does come in clusters. You'll have multiple days or even weeks with very low volatility, and then all of a sudden volatility will come back into the market. And whether it's down, more often a cluster to the downside in terms of volatility, or it's up, you'll often have these things occur in clusters. So they're not an equal distribution. That's one thing to note. But the other thing to note is just how extraordinary this moves. We've got, in this 2 trading week period here, you've got a 3 standard deviation move, 2 standard deviation moves, and 3 1 standard deviation moves. Now, to put that in context, normally a 3 standard deviation move would be expected to happen about once a year. A 2 standard deviation move would be expected to happen about once every 3 weeks. Well, and then finally, the 1 standard deviation move would be expected to happen about twice a week. Okay, so now add those up. Twice a week for the 1, every 3 weeks for the 2, and once a year for the 3. Now, think to yourself, how likely is all that to happen all in a 2-week period where we have a once a year event, a once every 3 weeks event twice, and a twice a week event, 3 times, and have all that occur, in less than 10 trading days. So this has been really remarkable action, and you really got to give it to the bulls that they have come in not just in earnest, but real momentum and strength, and that is pretty extraordinary action. In terms of our regular daily report, indeed, the market trend right now is a bull flag, and we've definitely been seeing that, as I mentioned with the graphs, just shallow 2-day pullbacks, and that's kind of what you expect when you're in this phase 3. The typical patterns are shallow pullbacks and then longer thrust with the bull market, and that's absolutely been painted here of late. IBD status confirmed uptrend. Accumulation distribution on the S&P is a B, a NASDAQ a C. Remember, the NASDAQ has put in 52-week highs as of yesterday, and yet it's on the back of not all of its participants and components. GMI index 6 out of 6, buy signal since 1019. That author remains in cash and is concerned if you read deeper into how he thinks about this. He's concerned about this relationship between the key moving averages. And indeed, if you look at the primary market condition, even after this some 235-point move, we're still in the long term in what would be called a neutral bear. And the decision points, we're still, in the long term, still down arrows all over the place. So a lot of this is still needing to be healed, even though we've come so far so fast. Consensus here is still in transition, but clearly a tip to the bulls. And if this were to continue, I would expect that these long-term arrows would start to flip. Intermediate-term market posture, very bullish posture with an upslope sentiment. Position sizing opinions are both at 100%. That intermediate-term market posture is now very bullish across all 4 indices. In terms of hedge warning status, we're at a 0+ normal with some elevated risk aspects, and really those elevated risk aspects are really kind of only 2 places right now. One, you have this distribution day count on the S&P at a 5, so that's a bit of a warning, and then the skew is actually up over 135, and that would represent about a 12% probability of a 2 standard deviation move to expected to the downside in the next 30 days. Everything else is very bullish. You see the New York Stock Exchange almost 4, or certainly more than 3 to 1, about 3.5 to 1, 426 on the new highs. All 5 of the intermarket risk aversion indicators are now solidly risk on. All of our special opinions are in good shape. And the only thing you really have to be concerned about at this point, based on the various postures and indicators, is that we're so high up, and at what point do you get to where the pot odds are poor? That was part of the reason why I was frankly surprised at just how bullish yesterday was. It would seem that the pot odds for continued move up versus pullback are starting to run pretty hard. This is pretty overbought at this point. And yet it continues to power up. So it's one of the things about using oscillators and the other similar things like MACDs and stochastic and other technical indicators. You have to remember that they can remain in an overbought condition for prolonged periods of time. So just because it's high doesn't mean that it's done. And that certainly was the case of the story yesterday. In terms of sector specific, as you would expect with this kind of action, we're looking pretty good, short to intermediate into long. There's only a handful, a sprinkling of neutrals in here still. Utilities being the most obvious, weakest sector in a relative term. But this is much improved. Also, in terms of the performance, 1 day, 5 day, 1 month, 3 month, even into the year, we're starting to see a lot more green than we did some 5 or 6 weeks ago. this has been pretty dramatic by all measures. So I think that should be more than enough for today. But some pretty interesting things going on in the market. If you find what we're doing here in the morning with our market preview is helpful to your trading, you can show appreciation by subscribing to us on the YouTube channel. We're just about to hit that 100 mark, and we'd love to hit that 100 mark. To be able to hit that 100 subscriber mark in the amount of time that we've been doing this is pretty remarkable. And that certainly is one way to show your appreciation. Like us on YouTube, retweet us on Twitter to your Twitter followers, to your StockTwit followers. You can send comments directly to support at Falcon Global Traders at falconglobaltraders.com. And then we won't spend much time on this today. We're at 20 minutes, but there are additional opportunities. Just go to this website. Go to this website. You can find out more information about what you see here. Just hit the pause button if you need more time to review those. And the same thing here with the disclaimers. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading.